Disclaimer: this video is only for educational purposes and not an investment or trading advice by any means. Any stock discussed is purely an academic exercise without any recommendation or commercial interest. Scientific investing as well as presenters may or may not have any investing or trading positions in the stocks discussed. During this video, we don't hold any responsibility for anyone's investing or trading losses. Please do your own due diligence or consult your financial advisor. Hi everyone, we will go ahead and welcome from Scientific Investing side. I am your host Kumar Saurabh, and today we have Mr. Amey Kulkarni, founder Candor Investing, for today's session on value versus growth investing in current times. And as we are doing this Twitter Space session for the first time, so I would give a little bit of intro about scientific investing, and then we will have intro of Mr. Amey, and then we'll go ahead with the session. So scientific investing, we legally got registered this year with the aim to spread financial awareness. And right now we have a YouTube channel where we try to put videos related to fundamental analysis, technical and quants. The channel name is With Scientific Investing. Also, we have a website, scientificinvesting.in. We have not marketed, but it's ready and you can visit, and soon we'll talk more about it. Coming to the occasion and our guest, Mr. Amey Kulkarni, so a little bit of intro about him. So Amey, he's a BTech and MBA with more than 9 years of corporate experience, where he has worked with companies like L&T, Larsen & Toubro, Jindal. And though he was investing in the market from 2007, 2008, it was 2017 when he took a full plunge and he became a full-time investor. And since then, he has been enjoying his investing journey. Amey runs a boutique advisory firm, Candor Investing, which partners with individuals and family offices in their journey of wealth creation in Indian equity market. And at Candor Investing, he invests in companies that do not require external capital in terms of philosophy. They have a long-term growth of them, and they are run by able, honest, and management which are hungry for growth. Also, Amey runs a course on forensic accounting to equip investors to make better investing decisions. Also, Amey is a small case manager. And personally, I know Amey since, though we had one or two telephonic interaction, the longer interaction first time it happened somewhere in September 2020. And that time Amey was the host and I was being interviewed. And right now the tables have changed, reversed. And this time I am interviewing. And this is my first interview. And, it can't start with a better person than Amey. So Amey, welcome. Thanks for accepting our request. And we are great to have you here.
Thank you, Saurabh. I think now you will enjoy being the host. Interview बहुत बढ़िया रहेगा, हाँ? अभी host बनोगे. Difficult सवाल पूछोगे.
I'm kind of, you can say, a little scared. This is the first time, but I'm sure this will go well with all the friends here and along with you.
Yeah, sure. So
Amey, why don't you start with giving us a little bit, telling us everyone about your investing journey. How did you start and how did you decided to get into full-time investing and all?
Oh, okay. Briefly, I'll tell you, everybody's investing journey actually starts with an IPO. So my father was employed with Power Grid way back in 2006 is what I think. And Citibank was there in his office. And you had to just show the employee ID card, and everybody, including officers and sweepers, and everybody was getting like a 5 lakh, 10 lakh, 15 lakh loan to apply for an IPO. That was a very big amount for a government servant, and my father was 56 at that time. So he said, Amey, what is this? I don't understand why people are giving such a big loan. I mean, what is in it? Basically, attraction to market starts with an IPO. I invested right through global financial crisis and the subsequent years. So I used to manage my own money, my family money since 2006-7 when I started. I did my MBA. During MBA, I was fortunate to be a student of Professor Sanjay Bakshi. So he's somebody who totally changes your approach towards both investing and life. And it was always a dream for me that my ideal job is something where I keep sitting the entire day and keep reading books and whatever interests me. uh, but I always went to corporate jobs. So I had corporate jobs for almost 9.5 years. Worked in L&T, Jindal Steel and Power, Siemens Limited before MBA. And 2015, one day I was sitting in the cafeteria with a friend, and he told me, Amey, whenever we meet, you keep talking about stocks, and why don't you take 20 lakhs from me and invest and take fees from me? So I said, no, I will not take fees. I'll invest for you. No, he said, no, I should be able to ask you questions. Why you lost me money, and then I said, makes sense. So that is how I started managing money for others in October 2015. And then it dawned on me that this is this is my calling and this is what I want to pursue. It took me another 1.5 years to realize that if I want to start up on my own, 32 is the age and not 42 or 52. So that's when February 17 is when I turned full-time investor. And last 5 years, I'm managing money for myself and advising others on it.
Great, great. I knew you are from MDI, but I didn't know you were also a student of Professor Bakshi. That's very interesting. So, Amey, coming to today's topic, value versus growth. And in fact, when I posted it on Twitter, we got few questions, and there was one interesting question where somebody asked about deep value. So rather than keeping it value versus growth, maybe we can extend it to deep value versus growth. So how do you see these three things? Do you think they're similar or different? Can you explain to the audience with few examples? What is your view on this?
Hey, sorry to interrupt. Sorry. Before we actually start the discussion, I think we should just give out a disclaimer that whatever we discuss here is only for educational purposes, and if like any names are taken out, should not be taken as a stock recommendation.
Yeah, sure. I
Yeah,
think
thanks, Shubham.
thanks,
Thanks,
Shubham. We
Shubham. Yeah.
always forget to make that disclaimer, but yes, the disclaimer is very important. So let me, I'll not keep it theoretical, but just to categorize these, two or three buckets. Basically, value investing is where you value the company, you value the asset, and you arrive at some approximate value, which is say 100 rupees. Okay. And you want to buy it at 30, 40, 50, 60, 70, or whatever X number, um, so that you have a margin of safety in the price. What this basically means is that you may have say a steel manufacturer or a auto component business where the values of the factories or the inventory or whatever physical assets this company has is probably more than the market cap plus debt, right? So that that over a period of time, the market will recognize that these assets are of value, even if they are temporarily not recognizing it. And so that you make that alpha or whatever the gap between current market price and the correct valuation of the company. That is what value is. Deep value is basically you get that same the same company at say 10 rupees instead of 60 rupees. So the gap is too huge, right? Some of the other things can be typically cash bargains. So I'll give you an example. There was a company, there is still a company called Piramal Enterprises. It was basically a cash bargain sometime in 2010 or 11. So what happened at that time was they had sold off their pharma business completely, and they had, now I don't exactly remember the numbers, but they had something like $3 billion or something. So almost 20,000 crores of cash, which was there on the balance sheet, and the entire market capitalization of this company was less than 20,000. So what the market was basically saying was, the company is actually worth less than the cash that is sitting on the books of this Piramal Enterprises. Now, that can happen if, so this is typically a deep value buy, where you buy the company for less than the cash that it has, right? Or you can call it, value investing. The problem with, so if I compare this with, today's, that there is one company called Hindustan Global Solutions, right? Something is happening in that, where they have sold one of their businesses. I think they have got some 4,000 crores of cash, and investors were expecting this cash to be distributed to the shareholders, either through a dividend or a buyback. But this company only gave a very small dividend and is now redeploying that cash in some different companies. There is some merger happening and that kind of stuff. So basically, at that point, the market was saying that Piramal's cash is not worth as much as it is, right? Now it's so ended. So that is like a value buy in 2010. But what they did at that time was they started a couple of new businesses. So they went into real estate financing, and then they started this complex generic drugs outside India. So these were some of the businesses that they started with that cash. So by 2014, it was a fast growing, profitable company. So it became like a growth company. It was like a value buy in 2010, where the cash on the books was higher than the market capitalization of the company. So so that is like a value buy, right? Where the assets or the cash flow, or the there is also a concept called debt capacity bargain, if people understand. So it's basically, the concept is that if you are a banker and you look at the profit and loss statement and the balance sheet of this company, and then you decide what is the amount of loan that you are willing to give to this company. So, just to give a rough example, if the interest rates are 10% and the company is making a profit of, say 100 crores, then roughly, it can easily service a loan of, say, 500 crores. So if the, say 500 or 600 crores, it can easily service, right? Or even more, up to 800, 900 crores it can service. So if the value of the company is less than the, the loan that any prudent conservative gives to this company, then it's basically called a debt capacity bargain. So the concept in value investing is that you buy a basket of stocks, multiple stocks, where the value of the company is much higher than the price, the current market price, right? Now you don't know whether these companies will actually make you money or not. So you buy 20, 25, 30 companies, right? Not all of them will give you profits, but many of them have so much safety in the price itself that in the end you will end up making money because of a combination of factors, right? What value investing does not take into account, or rather chooses to ignore, is that over a period of time, the next 3, 4, 5 years, the company will actually become better and the value of the company will increase. So it's like the सोने पे सुहागा, right? तो वो सोने पे सुहागा हो जाता है कि value of the company increased. So that is where the growth investing comes into part. So growth investing is when you are saying, okay, the current market capitalization 1,000 crores है. आज के डेट में based on cash flows, profits and other metrics, इस value की company 1,000 crores नहीं है. But because I like the company, I like the management, I like the business model, I like the industry, ये 5 साल 10 साल बाद ये बहुत बड़ी कंपनी बनने वाली है, और तब 10 साल बाद इसकी वैल्यू होगी 10,000 crores. तो भले अभी ओवर वैल्यूड है, फिर भी मैं 1,000 crores पे खरीद लूंगा. तो 10 साल बाद जाके आई विल मेक अ लॉट ऑफ मनी. So, simple example, if you take DMart in 2017, right? मतलब now in hindsight it is obvious. Everybody knew कि वो बहुत अच्छी कंपनी है, but nobody knew कि price इतना बढ़ जाएगा. Like IPO price से I think is more than 10 times now, right? So it was excellent company, fantastic business model, great management, proven track record, right? 15, 17 years of extremely profitable operations, and it was growing very fast. Something like that. So you tend to analyze the difference between value investing and growth investing is basically value में आप price और valuation पे बहुत ज़्यादा focus करते हो, and growth investing में आप focus करते हो on the softer aspects of management quality, capital allocation, industry dynamics, industry tailwinds, industry headwinds, that kind of stuff.
Sure, thanks, Amey. So another question related to this: in your journey of investing, One, have you taken certain value investing bets? And when you took these value investing bets, was it somewhere in your mind also that, okay, today this is a value investing and tomorrow it can become a growth investing stock? Because we always talk about these things like operating average, leverage possibility, re-rating possibility. So when it comes to value investing, is this an angle to explore that can this value investing stock of today can become a growth investing stock, or those are rare exceptional cases like example of Piramal you took?
इसका जवाब मैं थोड़ा सा अलग से देने की कोशिश करता हूँ. तो जब भी नया इन्वेस्टर स्टार्ट करता है फर्स्ट 3 4 5 years और एक्स नंबर ऑफ इयर्स तो वैल्यू इन्वेस्टिंग ज्यादा मतलब आई गॉट अट्रैक्टेड मोर टू वैल्यू इन्वेस्टिंग because it was definite and there were a lot of calculations. So I am good at calculations, right? So I wanted to look for bargains, I wanted to look for multiple companies, I wanted to look for evidence कि ये undervalued stock है. So it helped me build my discipline, it helped me build my investment philosophy, it helped me become a better investor. After that, a point came where I realized that more money is to be made if I am correctly able to decide what is growth investing, or correctly able to pick companies जो growth investing में बैठती है. अब let me also tell you, growth investing is probably a little more difficult because valuations are very sketchy over there. आप बाकी की बहुत सारी चीज प्लस क्या होता है, इट्स लाइक यू कैनॉट प्रेडिक्ट द फ्यूचर कि ये 20% CAGR पे ग्रो करेगा ही करेगा. लाइक डीमार्ट, ओके, आई थिंक द वे डीमार्ट इज राइट नाउ कुछ 200 PE पे है. सो इट बेसिकली नीड्स टू ग्रो some 189 price earning ratio, right? So its profits needs to grow at some 30-35% CAGR for the next 10 years, and then it needs to keep growing for a long time. अभी ये जो सर्टनटी है अबाउट द फ्यूचर, ये कहां से आएगी? ये नहीं आ सकती, राइट? तो इट बिकम्स, सो व्हाट आई एम ट्राइंग टू से इज इट इज मोर डिफिकल्ट टू डू ग्रोथ इन्वेस्टिंग एंड इट इज possible to go wrong in a lot of places. And the problem is once you go wrong, it really affects your confidence. Okay? And the third combination after that, when you have kind of realized, okay, you are now good at analyzing the management, you are good at doing forensic accounting, now you are good at trying to understand the industry and the different players, then you come to the position where you want to also look for companies which turn from value to growth, or rather where these are small mid-cap companies which have decent businesses. Over a period of time, the business actually substantially improves, becomes better, becomes more profitable, and a huge re-rating happens. Now, typically, this re-rating happens between bear markets and bull markets. So you want to invest in these companies during bear market and reap the benefits during bull market. तो bear market में 10 P, 5 P, 15 P पे मिलेगा ये स्टॉक, और बुल मार्केट में 50, 70, 80 PE पे एटलीस्ट आप हाफ बेच दो, 2/3 बेच दो, 1/3 बेच दो. So you book your profits and you realize a lot of money, right? I'll give you some examples, as simple as that. If you look at company called say Acrosil. If you look at Acrosil is like I think a 50 bagger or probably 100 bagger in the last 7-8 years, right? It was right. So 2011 the price was 15. The price is about 800 something today, right? So it's like what? It's 50 more than that, right? So it was a very mediocre company at that time. Of course, I didn't invest, but I had looked at this company. I was not too much convinced about the the credibility of or I didn't feel like investing. In hindsight, I was clearly wrong. But basically, this company used to be in granite sinks and that stuff, and the business kept on improving, the margins kept on increasing. I will give you a basic, what it went from to what. So in 2013, it was at a price earning ratio of 12, right? And now it is 40. So it has become a 3-bagger just on the P ratio expanding, right? At that time, it was making operating margins of about 16, 17. And today it is making operating margins of about 22. So profit has increased from 5 crores to 56 crores. So basically, this company has become a is a classic case of a value buy at that time, right? Which also had growth characteristics, and it has really paid off well. There are several other companies like Avanti Feeds or so many other companies that we can take. But what I want to highlight over here, it's not easy to be able to find that. So it's like one of 5, 6, 7, 10 companies out of 3,000-4,000 companies that are listed वो actually इतना अच्छा results देते हैं, and lot of other companies actually don't give good results, right? So in my opinion, start off with value investing, then gradually move on to growth investing. And it is always safer to put in more money during bear markets and be a little more cautious during bull markets. As simple as that.
So I mean, let me take an opposite view, because you said for somebody who's a beginner, he should start with value and then proceed with growth, because growth has a lot of assumptions. The one downside which I see in value investing and some of my early experience has been, many times what looks like value is not value, and that is where all the financial shenanigans and the forensics come into picture, because it looks value, but then later on you realize that everything was just in the air. So what is your view on the same, and how to take care of all this financial jugglery issue in value investing? That can happen even in growth, but more the value attracts more, and that is where many times people fail. So what is your view on that?
Right. So I'll tell you first is, if you're doing pure value investing, you need to invest in several companies. So invest in at least 25 companies, because what will go right and what will go wrong, you cannot tell prior. Plus, even if you are right, you don't expect to make more than 50 or 100%. Right? You're betting on the gap to close. So you're not betting on the company going up 10 times. So first is wide diversification. Something goes wrong, it's okay. It doesn't hurt you too much, right? Second thing is, if for 3 years nothing happens, right? I mean, you keep thinking I'm right, and the value becomes a value trap. Then you just forget it, exit. Even if you're still, like, this is a great company, exit it. Maybe you're wrong, right? There is something that you don't know. So, 3 years later, exit it, go into other companies. Now, when we come to financial jugglery, okay, इतना समझो इंडियन बिजनेस बनिया और गुप्ता मारवाड़ी चलाते हैं, राइट? सो देयर आर ये स्पेशल लोग हैं जो भी एंटरप्रेन्योर है, एनी एंटरप्रेन्योर, राइट? वो सब कुछ तो स्पेशल है बाकी एम्प्लॉइज से. तो एंटरप्रेन्योर्स आर 2%, बाकी 98% तो बाकी सब हम लोग तो एम्प्लॉइज है. अब नो, और इंडिया में कोई भी बिजनेस पूरा वाइट परफेक्ट हो नहीं सकता. जस्ट नॉट पॉसिबल. रेगुलेशंस, टैक्सेशन, सो मेनी अदर थिंग्स, छोटी से लेके बड़ी से बड़ी चीज कुछ ना कुछ आगे पीछे होता ही है. व्हाट इज अनपार्डनेबल आर बेसिकली अकाउंटिंग जगलरी. मतलब प्रॉफिट मैनिपुलेशन अगर कर रहा है बिजनेस, देन दैट इज अनपार्डनेबल. सेकेंड थिंग इज कैपिटल एलोकेशन. मतलब रिलेटेड पार्टी ट्रांजैक्शंस हो गए, पैसा किसी खुद के ही कंपनी को लोन दे दिया है, इंटरेस्ट फ्री लोन दे दिया है, या लोन दे के बाद में 4 साल बाद राइट ऑफ कर दिया है, या एक 1000 करोड़ का नया प्लांट बनाया, बट अगर आप वैसे कंपेयर करोगे तो बाकी कॉम्पिटिटर सेम प्लांट 200 करोड़ में बना लेते हैं. तो वही 1000 करोड़ खर्चा करके बेसिकली 800 करोड़ सिफन ऑफ कर दिए अपने सिस्टर कंपनीज को. So this used to happen a lot with power companies in 2004, 5, 6, 7. Especially, there is one company called Lanco, if you guys have seen. So that was like a 100-bagger during that time. But what they were essentially doing was, the power company was giving contracts to China-based companies which were related parties to construct power plants. And these China-based related parties will actually place an order for the equipment on Chinese companies. बट चाइनीज कंपनीज को देंगे 2000 करोड़ और यहां से बिल फाड़ेंगे 3000 करोड़ का. सो व्हाट वाज एसेंशियली हैपनिंग वाज, बैंक को बताया कि 3000 करोड़ का लोन है, सॉरी प्रोजेक्ट है, 1000 करोड़ में मेरी इक्विटी डाल रहा हूँ, 2000 करोड़ आप लोन दे दो. बट एक्चुअली वो प्रोजेक्ट था 2000 करोड़ का ही. दिस इज कॉल्ड कॉस्ट पैडिंग अप. तो बेसिकली 1000 करोड़ की इक्विटी निकाल लेते हैं. सो दीज काइंड ऑफ थिंग्स आर अनपार्डनेबल. बाकी छोटी मोटी चीजें अगर आपको इग्नोर करनी चाहिए, right? So if you are careful that you are not getting into fraudulent companies which are manipulating their profit and loss statement, then I think you are okay. Because see, I'll give you an example. There is this company called GHCL. GHCL is into that soda ash. So I had looked at this company in 2018-19. So it has उसका history थोड़ा खराब ही है. मतलब promoter was caught in a fraudulent real estate deal back in 2010 और वो सब problems थे. But now अभी ऐसा था कि promoter had resigned, professional management आ गया था. It didn't give me confidence कि I want to invest in this company. But this company during the bear market of 2018-19 was really, really cheap. And it was a very cheap business. So this was a classical value investing kind of a thing, right? You buy the business much cheaper than what the cash flows or the profits are suggesting. Price to earning ratio was 6 or 7. So ye tha. And what ended up happening after that was 1.5 years later, there was, soda ash prices went up. And, basically things improved. Business became even better. And market का sentiment company के बारे में change हो गया. So the price actually went up 4-5 times from the bottom during Corona business. I mean during last 20. So was it a great company? No, it was a value buy. But the returns were fantastic in the last 18 months, if you see. So even in 2019, the price was around 200. Okay.
Yeah, I think they changed the auditors also. If I remember, they got one of the big four as auditors. They tried to put a lot of focus there so that they improve their image. Though the promoter shareholding, I think it was low there. It was like in 15-16%.
That was actually the plus point because the fraudulent promoters had lost control of the company types, right? So it was, in a way, I think a good thing. So that, others could come in and at least steady the ship. So that was a classical value buy. So what I'm trying to say is, even if thoda sa damadol hai corporate governance mein, to bhi if you are not allocating too much money and you are focused on the business metrics and such stuff, you may end up doing still fine if you have wide diversification. Now, if you come to growth investing, basically what you're growth investing mein main bolta hu kya hai. Growth investing mein what is basically happening is you're at the start you're completely ignoring the price. Okay, what you are focusing on is the business, the industry, the competitive advantage, the management, right? The dedication of the management, the ambition of the management. So there are a lot of managements guys are rich. They have built big businesses. Now they want to chill. So it's not like they want to grow the business at 20-30% CAGR for the next 20 years. They are happy. They have made enough money. वैसा भी नहीं चाहिए. So growth investing में पहले आप management देखो, management capability देखो, management honesty देखो, management vision देखो, ambition देखो. All 4 things. Then you come to business metrics. Is it a profitable business? Is the addressable market big? Blah, blah, blah. So many other things, right? Competitive advantage hai kya? How is the industry? Is the industry growing? And all those dynamics. And then you finally come to price. So when you come to price, you should be comfortable buying at that price because you think there is a lot of growth runway left, right? So that is where then what happens is corporate governance is paramount at that time because you're overpaying. So you're not buying the company at 10p or 5p. You're probably buying at 30, 40, 50, whatever p that you're buying. And if things turn south from there, then it becomes a big problem. Okay. Then you basically, it's not only the money that you lose because sometimes your allocation is also higher, right? Because you're more confident. Third thing, it kind of unsettles you because then you start doubting your own decisions for the next company.
Okay, so I'll just summarize whatever we discussed so far quickly for the benefit of viewers, and then we will have little more questions around growth investing itself.
Yeah, sure.
So so we started with growth versus value. We defined what is value. Value means you are not factoring anything for the future. Growth means there is some valuation you are factoring for the future. Then we looked at some of the examples for newcomers. The suggestion has been to start with value because it's easier. In growth, the chances of going wrong is higher. And then again, we took certain examples. We also discussed a little bit about financial frauds and all, where the learnings are there'll always be gray area, because that is how India operates. But we should try to look for visible accounting issues, related party transactions, and those. So with that, I mean, let's move further in growth investing, because right now we are in, looks like we are in growth investing times, because I don't see much of value like typically we define. I mean, I find very hard to find value in this market. So even in growth, like how much growth and how much valuation? Like on one side, we could have companies which are growing at 15-20%, available at maybe 35-40 PE. But in recent times, we have IPOs where there is a 50-60% top line growth, but the profit is missing. And then there is a humongous valuation of 20, 30, 40 price to sales ratio. So where do you keep on the growth investing curve? That is one question. And second, how do you decide that how much valuation you have to pay in growth investing? Are you going to pay for these companies which are not showing profit? Can you throw some light on what is your approach to these two?
Sorry, you have touched upon a lot of things, Saurabh, and the answer is a little multidimensional. Okay, so let me first clarify. Growth investing is where you think that the growth of the business, profitability, right, profits, not just sales, is going to be much higher than what the market is expecting. So the first thing to do is understand the reverse DCF. There is a concept called discounted cash flow, and then there is a concept called reverse DCF. It's a little technical, so let me not explain this on this forum. I'll probably put out a video sometime later on YouTube or something like that. But it's a very common concept which anybody can understand in half an hour or 45 minutes. Basically, reverse DCF में इतना ही बोलते हैं, अगर आप 10% रिटर्न एक्सपेक्ट कर रहे हो अगले 10 साल में या 15 years में, तो how much should this company grow in the next 10 years for you to make just 10% returns, which is called the discount rate. तो अभी अगर आप रिवर्स DCF करोगे तो आपको ध्यान आएगा. So there is a company called Jubilant Foodworks, right? वो Domino's Pizza वाला, which has been a great investment for the last 10 years. But essentially, if you want to make 10% returns, it has to grow at 21% CAGR for the next 10 years at least. Now, are you sure that is going to happen? If you think it is going to be higher, then please invest, right? If you are not sure it is going to be more than 20%, don't invest. Now, the third thing is that, see, you look at these companies. Just one sec, guys, one sec. Yeah, sorry. So what happens in an IPO, right? In an IPO comes during bull markets and during great times. Why? Because the company wants to sell its stocks to investors at the highest possible price.
In the meantime, he's joining. I think Amey mentioned about this concept called reverse DCF. So to the audience who are not aware of reverse DCF, one thing what you can do is there is a financial screening website, Tijori Finance. If I remember Tijori, they have added a facility for reverse DCF calculation. So you can go and you can just on a click of button, you can do a reverse DCF and you can learn more about it. I think Amey has joined us. Amey, can you hear?
Yeah, I can hear you. I think this is काफी बार ड्रॉप हो रहा है. So I was
so yeah, go ahead. आप जब ऑफ गए थे, I just told them about Tijori Finance because वहाँ पे ना they can directly go and do a reverse DCF calculation.
Oh,
so that will give them some exposure. Yeah, go ahead.
Yeah, so see, I was trying to explain कि IPOs कब आते हैं. अगर आप एनालाइज करो एनएसई की वेबसाइट पे जाके, एवरी ईयर दे गिव कौन से IPOs आए और कितने आए ड्यूरिंग द ईयर. What basically happens is that IPO comes when these companies want to sell shares to the investors at the highest possible price. So why will any company want to sell at a lower price when people are willing to pay high, right? जैसे पेटीएम के CFO ने बोला, अरे people were willing to pay even higher price. मैं 2000 की जगह 3000 भी कर सकता था IPO की प्राइस. तो उनका वो गेम है. See, आप दूसरा समझो, you are not an insider, they are an insider. They know more about their own companies, far more about their own companies than we know. So they are going to price it higher. So this is not the, in my opinion, this is not the correct time to invest in these highly priced IPOs, expecting them to grow. So many of them will actually not, give back poor returns. The time to invest in these companies is when the next bear market comes, which could be 1 year, 3 years, 5 years from now. Right? By that time, things will be more clear. There will be more public record of these companies. Like some companies like Zomato, Policy Bazaar, or many of these companies are extremely good companies, right? But right now valuations are extremely high, and you never know what is in store in the future. So invest in these companies during bear markets. The chances that you will be wrong are much lesser. Prices will be much lesser. That's the point.
Sure.
So
Sure.
so basically what I'm saying is, to be a little more sure, so loss making companies is not a problem if the pathway to profit is certain, right? So there are a lot of SaaS companies, right? Right now they may look to be marginally profitable, or making some losses, that kind of stuff. So if you are sure that the things are going to turn substantially, then you invest. But how can one be so sure right now? That's the point.
Okay. So I will summarize the learnings. For normal growth, go for a DCF. If the growth is extremely high, but for the normal valuation, go for DCF. But if you feel the valuations are extremely high, try a reverse DCF methodology to see what is the kind of growth rate required to justify that kind of valuation. And the second learning was new companies, because promoter has a bias to sell at the best possible valuation and the market is good, the chances to make money is lesser. So wait for that cycle to play. In the meantime, the company history is also there, so wait for the next bear market. So Amey, shifting to next question. So when you invest, two questions again. One, what are the top 5 things you look at when you invest in a company? And what are the top 5 things which you see in a company you try to ignore that investment irrespective of whatever good opportunity it is?
So basically, I want a long public record of the companies. So I need to be able to look into the company in the past, multiple business cycles. What happened to this company? During good times, how was it doing? During bad times, how was it doing? Right? This is the number one thing that I want to look for in the company, so that I'm able to gauge and become comfortable with what is going to come in the future. See, it's not just about investing, right? It is about investing. Basically, when things turn bad, I should have the conviction and the confidence to sustain and keep holding the company if required. So then what happens is, that is the number one criteria. The number two criteria is, I want to look for companies which have a profitable history. So they have some competitive advantage. Somehow their business is better than most of the other companies in that business, in that industry. So they should have a superior brand, or they should have a cost advantage where their production is, production cost is lesser than its competitors, or they have a distribution advantage or some such advantage that they have. The third thing is the management. So I want to kind of make sure that there is no corporate hierarchy. So no big corporate governance issues. Basically, accounting fraud nahi hona chahiye. Okay? I'm okay with higher salaries where promoters take higher salary or something like that. Some such thing is fine, right? A little bit here or there is fine. No big major problems with related party transactions or historical, warrants, conversion price, mergers, acquisitions, no fishy mergers and acquisitions, that kind of stuff. So basic hygiene, factor of corporate governance is ticked off. The third thing is growth, kitna hai? And fifth thing is valuation. So given the valuation and the growth expectations, do I expect to make good money out of it? Secondly, I am quite also an opportunistic investor. So ऐसा जरूरी नहीं है कि only one type of company is to be there. If there is a company where I think I'm still going to make money and it doesn't fit into one particular thing like growth investing or something like that, then I'm still happy to buy. So for example, I made a lot of money in Ashok Leyland in the last cycle. So in 2019, just to give a simple example, Ashok Leyland is a company where there are a lot of corporate governance issues. Okay, but what I realized was we were in a bear market and we were in a downturn in the economy. So if you analyze the past 20 years of commercial vehicles, what basically happens in a bad economy, the sales of commercial vehicles reduces by 50% or more. And when the economy turns, automatically the sales of commercial vehicles substantially improves. Now, what I also realized was, see, economy will turn. कभी ना कभी अच्छे दिन आएंगे, बुरे दिन आएंगे. But the problem with most people was, अच्छे दिन और 3 साल नहीं आए तो क्या? What to do with that? So अच्छे दिन 6 महीने में आ गए तो I'll make a lot of money in Ashok Leyland. But 3 साल अगर इकोनॉमी की बैंड बजी रही तो क्या करें? So that was a problem where I classically identified that people are scared to buy it. They understand the logic, they appreciate the logic, but they are just scared to buy it. So I bought it and I kept buying every month. So it was like an SIP in Ashok Leyland. And I, on a decent allocation, I doubled my money. So that was it.
So one related question to this, because in many times when these kind of investments, it might take for the cycle longer than expected to turn, or even in terms of value investing, it's a game of patience. So behaviorally, how do you align it to have that kind of patience, especially in current markets, where you see all the neighbor stocks running and then your stock is not doing anything. So have you gone through those cycles where you felt frustrated, and what has helped you? Any pointers on that?
Fortunately, I am a guy since childhood. मेरे को, I mean, it might sound very odd or unique. Jealousy is an emotion I don't. मेरे को भी होता ही नहीं है jealousy. मेरे को भी प्रॉब्लम ही नहीं होता है कि somebody else का stock ऊपर गया या somebody else का salary ज्यादा है या somebody else is richer than me or poorer than me or whatever. I might say pathologically, I think it's a very fortunate trait to have for investing. But I can also appreciate it's a big problem. What I will also say is it actually becomes a bigger problem if you have not done enough study of your stocks. Problem क्या होता है कि it is one thing कि somebody else is getting richer faster than us. The other problem is the stocks that we have studied and invested in, उसमें conviction हमारा खराब होने शुरू होता है. So if our study पक्का है, study is in depth, study is comprehensive of our own stocks, then it becomes much, much, much easier to hold on to them, right? And be fine. So if somebody makes twice the money and I make only 30% returns, 30% is also great in a year, right? It's not bad. So, that's how kind of it works. But I empathize, it is really tough because, see, second thing that I always say to people is that stock markets is a game of regret. So what happens is that you make money, you will regret. You don't make money, you will regret. You make less money, you will regret. You make more money, you will regret, right? So that is what happens every time.
Okay. One more add-on question, because you spoke about history of company. You look for companies where there is a history. So do you mean post-IPO history, or if the companies, like let's say something like a ID Foods, like I'm talking because I like ID Foods, I like their dosas. So I have a very strong impression, but they have not done the IPO. So if tomorrow they do IPO, I have a history. So would you consider avoiding post-IPO history in those cases, or you need a post-IPO listing history for you to invest?
नहीं, ऐसा जरूरी नहीं है कि पोस्ट आईपीओ लिस्टिंग हिस्ट्री होना चाहिए, बट देयर शुड बी इनफ पब्लिक हिस्ट्री अबाउट द कंपनी फॉर यू टू बी एबल टू मेक सम गुड जजमेंट अबाउट द कंपनी. So ID Foods, there are a lot of YouTube videos, or he has given lectures in Harvard or something, some TED talks and all that.
Yeah.
So वैसे there is enough perception about the company. बाकी the red herring prospectus is a very the DRHP is a very comprehensive document. So that also gives a lot of information, including legal troubles and competition and risks and everything, industry structure and all that stuff. So for a company like ID Foods, I don't think I will look for public history. But for many other companies, I would want to see their performance during good times and bad times.
Got it. Got it. So again, to summarize, five things: looking at company history, a profitable history, some kind of advantage company should have either in terms of production or distribution. The management should be honest, no accounting or financial jugglery, and then comes the growth, and then comes valuation. My next question is, because the topic is value versus growth investing in current times, and I have seen current time little different, because this is the first time I have seen, and I have a history of active history of 6 years and active plus passive history of 12, 13 years. But this is the first time I'm seeing some people are telling this is just the start of a bull market, and some people are telling this is getting into a bubble market. So what is your view? Are we into start of something like a 2003, or are we like at end of a bull market, or this is just a market as usual?
Uh, so yeah, I'll tell you my perception, but don't assume that is correct, or so I'll just tell the listeners that it's just an opinion. You have to take inputs from multiple places and keep changing your opinion. I think दो तीन चीजें हैं. एक तो corporate balance sheets are deleveraged. Okay, banks are in a much better shape, so they can lend more. Third thing is, a lot of money has been printed in the US, which will kind of flow to other places, both in terms of equity investments and capital investments. So investment in actual companies. A lot of startups have made a lot of money, and these people have got rich. They have many of these. So this Flipkart, कुछ बोलते हैं ना flip. So Flipkart people have kind of started some 200, 300 companies, right? I mean, the early employees of Flipkart. So what I'm trying to say is the corporate balance sheets are deleveraged, right? They have ability to borrow and invest and expand balance sheets. The banks are in a better shape. Lot of money has been created by startups, right? A lot of these employees are now rich. They are starting up new businesses. The third thing is that I think so there is two matrices. So one is the interest rates, and the second is corporate profit as a percentage of GDP. So there is this great talk by Buffett in 1999, where he gave this talk, and it's a very famous talk. So basically, he said that if you take long periods of time, more or less the returns you can predict based on two parameters. One is the interest rates, and the second is corporate profit as a percentage of GDP. So for India, when interest rate reduce over a period of time, then automatically stock valuations improve. So your returns are better. So now what happens? Is that in India, interest rates are quite low at this moment, but corporate profits to GDP is on an uptrend. So they were very low, around 1.7, 1.8% in 2019, which is now increasing. So if you take out 5 to 10 years from now, if interest rates remain at this point, but corporate profits will probably improve. So I don't see a big crash coming into the markets. So I think we are at the start of the next bull run in a way. But having said that, there are always pockets of overvaluation. Like some of these companies, which are not even growing so fast, are available at 70, 80, 90 price to earning ratio type of thing. So those kind of P ratios are only warranted for really great fast growing companies which are going to be much bigger in the future than what they are now. So I do see pockets of overvaluation, but I don't expect a big crash or the economy to go into a downturn. So we may still keep growing at 7.5% for some time now. So but we never know, what will happen. So in the future, if things turn south, it turns south.
Got it.
See, I'll give you one more data point. Okay, so if you look at the two very important things actually. So this Asian countries which prospered: Japan in 50s and 60s, Singapore in 70s and 80s, South Korea in 70s and 80s, China in 90s, 2000s, right? Every time that these US started business with these companies and started outsourcing manufacturing to these companies, these countries grew leaps and bounds, right? The second factor was, during these times they had a young population which was educated. So they had 80-90% literacy rates. So today I think India is around 75% literacy rates. What it basically means is that the low skilled but semi skilled and low skilled jobs can be outsourced at much cheaper cost to these countries. So India today is at that sweet spot where we have a very young population and we have a lot of people who can read, write, so that they can learn certain skills and do these semi-skill jobs. So I think next 10. So that is why so many people keep saying that the next 10-20 years are going to be like really great for India. And so there is this book by Sanjeev Sanyal, India's Renaissance or something. So he explains out this theory quite well in that book, where he's saying that opening up to the US and demographic advantage. So he also talks about the same demographic advantage benefiting America and England. The only difference was in England, what happened was this demographic advantage played out over a century. So their population slowly grew and now it is into slow decline. With India, what is happening is it's happening very fast. Like, we have a lot of young population now, and then 20-25 years later, the fertility rate is going to drastically reduce.
Okay. And Amey, what was the Mr. Buffett's letter you said? Which specific year?
So 1999, he had given a talk. So Carol Loomis, if you search for Carol Loomis, Warren Buffett, 1999, you will get it. Basically, he's arguing for interest rates and corporate profits to GDP. So he kind of predicted that for the next 10 years, in 99, when they were at the top of the bubble, he basically predicted for the next 10 years the returns in the US are going to be mediocre. That is exactly what happened. Do you want to open up the floor for some questions? Because I think people have been patiently listening for a long time. Because of these technical issues, we have lost a lot of time.
Sure. So we'll open the floor for question. And Amey, in the end, if you can put your views on 2022, which are the sectors you feel is attractive. And I'm opening the floor for question also. So I have 5 requests. I will unmute one by one and kindly ask your questions. So Amey, one question on 2022, where do you see which are the pockets of opportunities? And in the meantime, I will also check if there are questions on Twitter.
So this is a very tough question to ask, to answer. कौन से sectors में क्या opportunity मिलेगा? I think real estate is in a cyclical upturn. So the way to invest in. So what I'm doing is basically I'm investing some money every month in a couple of real estate companies, where it's like I'll keep investing for the next 1, 2, 3 years till sales, business keeps improving. So I expect to make decent money out of it. I'm doing the same for my investors. So it's like an SIP, not in a mutual fund, but in a real estate company. Right? When good times come, really good times come for these companies. I think US investments are going to become attractive sometime soon, right? But there will be a lot of time. I think there was a very big bubble if you leave the top 10 companies like Google, Facebook, and those companies, they were not in a bubble. But a lot of other companies good companies were in a bubble. A lot of stocks have corrected. So if somebody is looking at US markets, I think that is a good fishing ground. Baki for India is also, I think, individual companies will always keep presenting some opportunities. I think financials should be a good sector, hunting ground, because history suggests that after a severe pain like global financial crisis or the NBFC crisis in the late 90s, or the current corona crisis or demonetization or any of these big crises that happen, it basically opens up a window of opportunity to invest in financials. But you need to have the ability to bear a lot of pain, because it's not like suddenly financials are going to turn. And secondly, it will take 5, 7, 10 years for really good money to make. Basically, the game is to find the IndusInd Bank of the next decade. So it's not, you're not trying to find an HDFC bank. You're trying to find an IndusInd Bank, which, turns from a bad bank to a respectable bank.
Okay. Okay, thanks. Amey, I've unmuted Pramesh. Pramesh, you want to go ahead and ask your question?
Yeah, can you hear me?
Yeah,
Yes, we
Pramesh, go
can
Yeah,
hear
ahead.
you.
great insights. Thank you very much for your sharing your experience on this. And my only question is, where do we start to find value from? I mean, how will listeners can benefit in terms of scanning this? From what are the P filters, or what are the filters from where they can actually find this?
No, so you're talking about no, just I didn't get your question
How do
properly.
we start to filter for finding value stocks?
Start with
Like, do you have
screeners.
a scan?
Go to screener.in, filter for companies, I mean, really basic start if you want to do, you filter for companies which have, grown their sales over a certain period. Say, all companies which have grown sales over the last 5 years by more than 20%, whose profits have grown by more than 20%, return on equity average over for last 5, 7, 10 years is say above a particular number, which could be 15. The debt to equity ratio should be less than say 2 or 1.5. This is how you will generate a list of stocks. After that, you will have to go stock by stock by stock, where if you want, so you will be able, one must be able to quickly reject certain companies, so that we don't spend too much time on the wrong companies. Okay, so the art is basically to reject more than to accept. Now, once you have rejected a lot of companies, 10, 15, 20, 30, 40, whatever that number is, that number will remain. And then you scan through which of these companies you would like to buy and hold for a long time. So it's more of a rejection game than a selection game.
Okay, so basic criteria to filter is more on the profitability, growth, and those aspects.
See, that is how you can start, right? So that you don't go wrong with the names of the companies. Now,
Fair.
once you have gone through a few, say the financial, basic financials of 100, 200 companies, then you will kind of figure out, there would be some turnaround stories. There would be some companies which are having great, big capacity expansion, some new product, expansion in margins, those kind of companies which on paper right now look very bad, but, could be better later. So they will not, so this is how Dhire Dhire started.
Okay, okay. I did something like very similar to as what Joel Greenwald formula is there on P and earnings yield.
Magic
So
formula.
yeah,
No, so magic formula logic is different, Pramesh. Magic formula is you blindly invest in whatever companies are thrown up.
no. I'm only referring that could be one of the ways to filter the list. I'm not saying that go exactly by that. That could be one of the scanners. I mean, if you
That cannot be a starting criteria. Magic formula basically says this is formula investing. You just buy all the companies that come into the magic formula. So if you decide that you're going to buy 20 such companies, you buy all those companies, irrespective of what the names are. Magic formula doesn't work if you start picking and choosing magic formula. Of course, that can be one of the starting points to find one such great company. That is also fine, but one has to also look at magic formula from what is called as factor investing. If you just keep buying magic formula, you still beat the index and you will do a good job.
Got it. Got it. So we should look at more as a factor investing. There is one more question, Amey, on the exit strategy, specifically with cyclical. So how do you plan with the exit strategies in cyclical type of stocks?
Exit before everybody else does, well in time, before the profits start reducing or the cycle starts turning. So leave money on the table. Be okay with the company going up 50%, 80% after you have exited. Otherwise, it will always be too late.
Okay. So don't wait for the profits to dip, but before that,
Exit
and always
early.
leave something
Exit
for others.
early. Be okay with not making the last 20, 30, 40%.
Okay. I
Was
will
more
try to
around
add.
PE re-rating. So I see a lot of good companies being said, being quoted at very high valuations, and the reason being said is the numbers are okay, but the runway is so high, so they deserve a better re-rating. I mean, there are some companies which have been for decades, say Relaxo, which was identified say 10 years back in 2010. It's already trading at say 40, 30, 40 earning multiple, say around 4 or 5 years back, which was apparently very expensive, but now it is trading at say 100. I mean, should you? I mean, where is the valuation comfort in this? I mean, and say today, if I identify a company which is say trading at a 30x earnings, should I be okay and should I expect P-rating in the future if the earnings go on?
PE rating is only a bonus. Okay, you cannot start your investment thesis with PE rating ho jayega. Okay, so you come for the basics of the business, and if so, I'll explain you the logic of PE rating. What happens is PEs will be much lesser. So 30 is a decent PE, it's not a low PE, but PEs will be much lesser when everybody doesn't accept that this company is good, but you think that the company is very good. So you have identified the company early, or you have bought a certain position early. Now in future, what ends up happening, it becomes a better business. It becomes, the moat becomes bigger, the competitive strength becomes bigger, profits increase, operating margins increase, so many other improvements happen in the business. At that time, bigger institutions whose cost of capital is lesser don't mind entering this business. Now, for a lot of times, what happens is a lot of these institutions don't want to invest in companies when they are much smaller, purely for size reasons. So many of them either don't think the company is good, or sometimes uh, uh, so either the company is not good, or they are waiting for the company to attain a certain size so that it becomes investable. Secondly, for these big institutions, the cost of capital is much lesser. So you want to make 15% returns minimum on your portfolio, right? Because you're a small investor, relatively. But a pension fund or a mutual fund is happy with 10%. US pension fund is happy with 6%. So these companies, they will buy into the stock at a much higher PE than you later when the business becomes better and bigger. So relaxo के साथ वही हो गया है. What has happened is, it was a good business. It is still a good business. At that time, it looked expensive at 40-45 PE, say 5 years back. But so many other good big investors have now invested in it who didn't invest at that time. So basically, what has happened is it has become a very expensive stock now. Right now, the question is, if you are holding it, it's not it's not advisable to sell. But if you are contemplating new investment, that is a big question mark. Was I audible?
Okay, I hope Satyajit that answers. So Amey, should we end here given the the issues which are going on with the infrastructure?
I think so. I think what I will request, guys, I think if you guys have more questions, I think just send me an email or send me some a DM or a tweet on as a reply to this session. Maybe I will try and host a separate session again, 1 hour session some other time, where hopefully we'll have lesser issues, right?
Sure. Thanks, Amey. And Amey's Twitter ID is @Amey AMEY_candor CANDOR. You can see in the title. So you can DM him. Also, whatever we have discussed, all this recording, it will be edited and we will upload on our YouTube channel, which is Scientific Investing. So, and as Amey said, if there are a lot of questions, he will try to set up some other time, and hopefully we will have a better session next time. And you have been a great audience. I mean, there are so many issues and still you are there, you are listening. So thanks a lot for your patience. Thanks for all the questions which came on Twitter, which came here. Hope we could have a better infra and we could have gone a little longer. But again, I think it was a Friday well spent. Thanks for your time. And especially, Amey, thanks for giving us your time and thanks for enriching us with all your learnings.
Thank you so much, guys. Just reply back to the invite with your questions. I will try and do one more session and address specific issues or specific questions.
Sure. Thanks, Amey. Thank you, everyone.